Welcome to this explainer. Have you ever caught yourself just wishing you could wake up tomorrow with literally double the money in your bank account? It sounds like pure fantasy, right? Like some kind of get-rich-quick scheme. But what if I told you it isn't magic at all? It's actually just math. Today, we're unlocking a mathematical secret to wealth that makes doubling your money entirely achievable. And the best part? You absolutely don't need a fancy finance degree to pull this off.
And hey, this isn't just some trendy modern internet hack we're talking about here. Allegedly, Albert Einstein himself actually believed that the Rule of 72 was a more important discovery than his own theory of relativity. Can you believe that? And the very first recorded reference to it dates all the way back to 1494, hidden in the financial text of Luca Pacioli, the guy known as the father of accounting. So when the absolute brightest minds in physics and mathematics revere a concept this deeply, well, we should probably be paying close attention.
Okay, let's dive right into this. The entire focal point of our explainer today revolves around a single, super simple two-digit number, 72. I know, it looks incredibly basic, right? But this number is an incredibly powerful tool. It's essentially the key to unlocking your financial timelines and seeing exactly what the future holds for your hard-earned cash.
So here's the formula, and it really is brilliantly simple. You literally just take the number 72 and divide it by the expected rate of return, the interest rate on your investment. The answer you get, that is exactly how many years it'll take for your starting money to double. Boom, that's all there is to it. No complicated algebra, no massive headache-inducing spreadsheets. Just 72 divided by your interest rate equals your timeline.
So here's our roadmap for today. First, we'll look at the secret ingredient. Second, we'll do some testing scenarios. Third, beating inflation. And finally, supercharging savings.
Let's kick things off with Section 1, the secret ingredient, making the rule work. Now, before you start eagerly dividing numbers, you really need to understand that this rule only works when it's paired with compound interest. So, compound interest is basically when the interest you earn on your initial investment gets added right back onto that starting sum. You aren't just earning money on your initial cash, you're earning interest on top of past interest. It creates this continuous, snowballing cycle of growth, literally stacking your money upon itself over and over again. So the recipe for real financial growth really boils down to two straightforward steps. Step 1. You need to invest your money in a vehicle that offers a high compound interest rate. Step 2. Just forget about it. Seriously, let the cycle run. The longer your money sits there completely uninterrupted, the heavier the lifting that compound interest does for you. It's essentially just an exercise in patience, letting the math work its absolute magic.
Moving right along to Section 2, testing investment scenarios. Let's do the math.
All right, I want you to grab your phone's calculator right now. How long do you think it'll take your money to double in these four really common scenarios? We've got a standard savings account at 1%, government bonds at 5%, mutual funds at 8%, or stocks at 12%. Keep that golden formula in your head. 72 divided by the rate. You got your guesses ready?
Okay, let's look at the answers. Notice the massive, frankly life-changing contrast between these timelines. Look at that top row. 72 divided by a tiny 1% savings rate means you are waiting 72 long years just to double your money. But look down at the bottom row. If you manage to secure a 12% return in the stock market, you're doubling your investment in just 6 years. I mean, the difference between waiting 72 years and just 6 years is literally an entire lifetime. And this is exactly why hunting for a higher interest rate is absolutely crucial to your financial growth. Which brings us to Section 3, beating the inflation rate, when the rule costs you. So, we know this rule is fantastic for making money. But what about the reverse? We all hear the word inflation constantly, but what is it actually doing to your wallet? Well, the inflation rate is the rate at which prices tend to increase over time. Practically speaking, it means it costs you more money to buy the exact same groceries today that you bought last year. It's this invisible force just constantly eating away at your purchasing power. And here's the kicker. This exact same rule of 72 can calculate exactly how fast your cost of living is going to double. If inflation is sitting at a relatively normal 3%, well, 72 divided by 3 means everyday prices will double in 24 years. But if we're facing high inflation, say around 6.8%, 72 divided by 6.8 means prices are doubling in just 10.6 years. I mean, think about that. In roughly a single decade, your everyday living expenses could be astronomically higher. You absolutely have to use this math to plan ahead so that you aren't completely beaten down by the rising cost of living.
Let's look at a practical application in Section 4, supercharging your savings, protecting your $1,000.
Okay,
Here is a very realistic, everyday scenario, the $1,000 dilemma. Let's say you have $1,000 of hard-earned cash that you want to save. Do you choose the lowest hanging fruit, which is just parking it in a standard local bank savings account? Or do you do a little digging, sit down with a professional, and seek out an index program with a guaranteed higher rate?
The visual contrast between these two choices on the chart is staggering. That first bar represents that local bank at a 1% rate. As we calculated earlier, you are waiting 72 years for that $1,000 to magically become $2,000. Let's be frank here, you likely won't even be around in 72 years to see that money double. Now look at the second bar, a guaranteed savings program at 5%. 72 divided by 5 means your money doubles in about 14.5 years. Instead of waiting a literal lifetime, it takes just a decade and a half. Choosing that 5% route isn't just a smart move, it's a sheer necessity.
But before we wrap up, we need to talk about the fine print, limitations of the rule.
While this is a famously handy little calculation, it isn't flawless. First off, the rule strictly applies to assets that compound annually. Furthermore, there's kind of a sweet spot for its accuracy. The rule's precision actually drops significantly for interest rates below 6%, and it drops again for rates above 10%. But most importantly, this rule is just a quick shortcut for estimations. It does not replace real, actual professional guidance. You should always use this knowledge alongside a financial advisor to find the very best route for your specific situation.
So I want to leave you with this final, really important question. Look at your own accounts today. Honestly, how many years until your money doubles? Start calculating. I challenge you to use the rule of 72 right now to evaluate exactly where you stand. Start exploring those high compound interest vehicles we talked about and begin your journey toward financial freedom today so that you don't have to be patient for too long. Thanks so much for joining me on this explainer, and hey, happy calculating.